You guys are definitely in for a treat tonight. We are joined by Joe Wanagel, who seriously has such an impressive portfolio, and I can't wait for him to share some of the tips and tricks he's used to not only own over 100 units, but self-manage in and out of state. So he'll be going through a lot of different detail. But Joe, we're super excited to have you here tonight. And I know you have a presentation for everyone, but did you want to just tell us a little bit about yourself and kind of what's the secret sauce to your success in real estate investing?
Sure. So I've been doing this since 2003, so a while now. And I mostly what I do is I kind of get little rougher buildings, fix them up, and rent them out and get my money back out and keep going on.
I love it.
I'm about 100 and I guess probably 120 units now, maybe somewhere in that range. I don't know. I bought 5 buildings last year, so it's hard to keep track now.
It's good when you start losing count, right?
I guess.
Awesome. Well, I know there's probably gonna be tons of questions, but I know you have a presentation prepared. So if people do have any questions while Joe is presenting here, please feel free to put them in the chat. We'll definitely try to get to all of them near the end. So we will allocate some time for that. But Joe, you want to go ahead and take it away?
Yeah, let me share my screen here. All right, I'm going to get a little number intensive with you guys here today, but here we go. So first, I just want to quickly go over, a cap rate, because I know until about, 5-6 years into it, the cap rate was still very confusing to me because everybody does a little differently. But a cap rate, this is how you're supposed to do it, is you have your gross yearly rents, and you take out your vacancy, your management, property tax, insurance, utilities, maintenance, and capital expenditures. It should always have at minimum, these expenses. When you get into a lot larger buildings, you might have employees and, more stuff on there, but at minimum, it should really have this. And a lot of times when people are listing 1 to 4s, they'll get rid of the vacancy, they'll get with the management, they'll get rid of the capital expenditures to make their cap rate look a lot better. But it should really have all these in there. So anyways, you get your total expenses, then you have your net operating income, so what you make all together after expenses. And then you divide that by the purchase price, and then you times that by 100, and you get a 6.8 cap rate in this example. A 6-point cap rate, 8 cap rate just basically means that you would make 6.8% on your money if you bought it in cash before appreciation. So hopefully that makes sense to everybody. I just always like to go over that quickly, so when I'm talking about cap rates, nobody's confused. All right, so here's what I call the math of making money. I basically just sort of did an example property of how it kind of works over 5 years if you do it right. So here's year 1. You got your rent less all your expenses, and your net profit would be 26,128, and you get a cap rate of like 6.53. There's your building value. If you bought it for $400 at 4 units at $910 a unit. Your yearly payments would be this at a 5% interest rate. Your yearly cash flow would be $6,802. Your principal pay down for that year 1 would be $44.26, and your loan amount after that. And I just extrapolated it over 5 years to kind of give you an example how it works. And basically what I based this on was if you raise rents by 3% every year, and all your expenses went up by 3% every year. So if you come down and look over here, your total cash out would be this $42,089, and then you would pay down the mortgage $24,000, and then you potentially at that point, if somebody bought it for the same cap rate that you purchased for it, you could get a new loan for $339,000, which would give you cash out of $63,828.74. So between cash flow and cash out, you could get a total of 105. And if you buy a building for 400,000 and you put 25% down, then after 5 years, you could potentially get all your money back out. The big thing I would want people to notice here is my cap rate is 1.5 higher than my interest rate. And that's a big thing. I like people to know is you really want it at least 1.5 above. Now, most people actually probably want to grow more quickly in this. So here's a trick. Same example. And what if you raised rents by 10% the first year and then 3% thereafter? So then if you come and look down here after that, your cash out after 5 years between cash and cash out, if you refinance it at a 5% interest, assuming somebody bought it for the same cap rate as you, have 173 total dollars. So you go from 100,000 to 173,000 in 5 years. So in a lot of ways, if you can find a building, it's always good to find a building that you have that room to do, a little bit of larger rent raise that first year. Sometimes these numbers can all be better. Sometimes they can be worse, but usually general thumb, you want to raise your rents probably by 3% every year. And if you can, jump it the first year because it really jumpstarts your going forward. And that comes to this again, what's a good cap rate? You really want 1.5 higher than your interest rate at minimum. I wanted to go over a couple property condition levels because people are always looking at properties and thinking about, well, do I want one that's really rough or one a little better or this or that? So first is vacant with power off. This is probably the most difficult property type because once the power is turned off and it's been off for a little while, you often can have city problems. So the city will then say, oh, I don't know if it meets the current zoning, or they want you to bring it up to current things. And maybe the current zoning doesn't allow for as many units as you might have or what you got there. So you kind of have to argue to use what you already have there, which seems a little crappy. And that process will take often a year to year and a half to get through it. So something like this, you want a really good deal if you're going to buy it. And you want to be pretty experienced because you're going to have to deal with a lot of stuff, including a lot of city stuff. Now, vacant power on, this is better than the vacant power off because you could still want to get a good deal on it, but the power's on, so you don't have to fight the city. So you can usually start fixing a vacant with power on almost immediately. So you can just start going in there and fixing it right away. It's a lot easier than waiting a year and a half permits. These two properties often tend to be cash properties. So you're either going to have to buy them with hard money or cash. So also anytime you're doing hard money or cash, you also are going to want to get a much better deal on it. This is the one where most people are probably going to want to be at. Has tenants, but needs improvements. So you already got tenants in there. You already got somebody paying rent, but you can, what they call value add. I lost it. There we go. Value add. So you can do a couple little things, get some rents, higher rents, and really speed up your process to buying another building from the cash from that building. Number 4, I've never actually bought one of these. So well-maintained and market rents. I've never bought one of those, but this is actually would be a good property if you're somebody, you got a pretty high paying job. You're just kind of looking for something better in your 401k. And it's already got property management in there. It's maintained well. It's at market rents. That would be a good one for you because in 5 years, you're doing way better than you would with a 401k or anything else. Okay, so here's an example of this in Clarksville, Tennessee, 6 unit. This is an example of a vacant with power off. To give you an idea, we bought this it's almost a year and a half ago, and we're just about to get permits probably in the next month here. And that's the crappy part about vacant with power off, because we had to argue with the city saying, how can we fix what we got? And they're like, no, and we had to go to these meetings and they postponed them and pushed us off, and you have to go through the process. And but it looks like we're finally going to get permits here. But we purchased for 85K. We're probably going to put about $270,000 into it. So we have a total cost of $355,000. Our estimated yearly income is going to be $61,200. Good news is rents are going the right direction there, so maybe we can get a little better than that. Estimated year expenses should be in the 24,180, and our NOI will be in that 37 range. So on this one, we end up with like a 10.4 cap rate, which is really good, you know, and this is the kind of cap rates you want to hit if you're really going to go through all this hassle. Otherwise, it's just not worth it. But if we value at a 6 cap rate, be 617,000. So we could potentially get a loan at 5%, 460,000. So hopefully when this all is finished, we'll end up 105,000 ahead of the game. So we'll have 105,000 more out of it than we put into it. So then we can go out and take that money and buy a bigger building. You can actually get a little better than 5% cap rates, 5% interest rates right now, but you know, interest rates are rising right now. So I always try and be conservative on things instead of the other way around, because that's how you get yourself in trouble. Here's one with another Clarksville property that we purchased. It's triplex. It's vacant with power on. We purchased it for 50K. I'm hoping we put a little less than this in it, but we'll probably put about 100,000 into it for repairs and 150. Estimated gross yearly income 27,000. Estimated yearly expenses 10,650. NOI 16,350, and cap rate 10.09. So we're still getting a really good cap rate here, and we bought it like 3-4 months ago, and we're already halfway through all our repairs. So vacant power on, you get to start right away. So it's going to save us a year or more in time. So hopefully in the next couple of months, it starts giving us a lot, you know, bringing in money. We can finance it, and hopefully we get a, you know, like a $200 and some thousand loan, and then cash out 54,000. So 54,000 more than we put into it. So we'll put a total of 150 into it and get a loan for 204,000. And these are the properties I bought in the last year. So these are real properties, real things that we got here. So here's another one. Is everybody able to see that, or are we? All right. It's a Spokane. We bought this in Spokane. It's a triplex. We purchased it for 185K. Rents at time of purchase are 27,900 last year. Expenses about 1375, and NOI about 14,115. So we purchased at about a 7.62 cap rate. Honestly, it's hard to find buildings at that good a cap rate right now, but the way we did it on this one is I actually bought it in cash. The guy kind of wanted to close quickly. He really wanted to get rid of it, and we're like, we kind of lowballed him, and he said okay. So wrote a check, and there we go. Proud owner of this new building. So here's that one. So already we did the trick about the 10% right away. So that's the first thing we did, is 10% right away. And you can kind of go through our vacancy, property taxes, and all that. And so now we're at a net profit of 16,110. These are pretty close to numbers, maybe off by pennies here or there because I rounded. And we haven't owned it for a full year because we've only owned it for, I think, about 5 months now. I also did this based on if we had gotten a loan on it, but I actually just paid cash for it. Building value at a 6 cap rate would be 268,500, which would mean already we could just refinance that thing and get money out, which is nice because we only owe 185. So potential loan amount at a 6 cap rate and a 5%, we potentially could get a $200,000 loan. So this is a super good situation because day one, we got tenants in there. All we have to do is wait 6 months, because to do a cash out on 1 to 4, typically you got to wait 6 months before they'll do a cash out for you. So this one's going to be great. Put 185, and 6 months later, we get 201,000 out. Now, we're hoping, since it's 1 to 4, you can actually go by, sometimes they don't go by cap rates as much. So our actually break even per month. So if we got a loan at 4% for 280,000, we would break even every month on that property. And so that's what we're going to actually shoot for a loan on this thing, is 280,000. So hopefully we can get, about 90,000 after, financing costs and all that kind of stuff. But if you extrapolate this out by 5 years, you can already see just by cash flow, we'll get almost what we had put for a down payment into it. And then also total money out, we might be able to get 230,000 out of the thing. So anyways, this is a pretty good balance. We're pretty happy about this one. And it's also super nice because day one, you're making money on this thing, right? And that's super awesome. So these are the things you really want to look for if you can, is find tenants, needs improvements. Hopefully you get it for kind of a little under market, and then hopefully 6 months later you can pull money out and then just go forward. Some of the advantages of out of state is you're not limiting how many deals you can find. So you can look in multiple areas, multiple things, find multiple deals, and it gives you a lot more chances to find deals, especially in times like now, which are it's been a little difficult, but they're not like in 2010 to 12 where they're all over the place. You're a little bit more forced to set up for unlimited growth because you're only going to manage an out-of-state property for so long before it's too difficult to do yourself. The triplex we bought in Spokane, since we already had tenants in there, we're actually managing it ourselves right now because we already have tenants, so why not? So we're getting a little bit more money there. But you're forced to set up for unlimited growth. You have to set up procedures and whatnot. You're not managing the building. You're hiring people to fix stuff. You kind of set up for having many, many, many buildings instead of just what you can handle personally. Diversity, people always say diversify your investments a little bit. So you're diversifying areas because some areas do better than others. Maybe one area is good and then it goes crappy. So you're kind of diversifying your investments a little bit, and that's always a good thing. It does give you a little bit more freedom to travel, that kind of stuff, because if you're doing all out of state and everything, you're just basically working on your computer, and you can kind of do that from anywhere. A lot of people are working from home nowadays off their computers, and so it gives you that. Couple of local advantages that I've definitely found is you can pay yourself to manage it. So especially in the beginning, if you got lots of time but not so much money, if you can find something locally with good numbers, you can manage it yourself and pay yourself to manage it, because obviously you can treat a local property the same as you treat an out-of-state property, but the real reason to go out of state is probably if you can find properties that are better numbers. You can pay yourself to repair it. I mean, if you're hiring a guy for $2,000 to paint a place and you don't have anything to do that weekend, you could make yourself a couple $1,000. So those are some advantages of doing it locally. You can see the property regularly, so you can drive by it, see what's going on, that kind of thing. And that's nice if anything weird's going on. More aware of the location. Obviously, if you live there, you're going to know sort of the better parts of the area and those kind of things. So you're a little bit more aware. So there are some positives of doing locals. But ultimately, if you grow large enough, you're probably going to have to treat everything like an out-of-state property anyways. But it's mostly about finding good numbers. And so you don't really want to limit yourself to just being local. If you can only find 5 cap rates locally, but if you go out of state and you can find yourself at 8 cap rate, well, you're probably better off doing the 8 cap rate than the 5 cap rate. And you might as well do it that way. So I kind of want to go into rising interest rates a little bit, because to just give you an example of part of what you got to do as an investor is you do have to predict what's going to happen a little bit over the next few years so you don't get yourself in trouble, especially if you're going to a project property where maybe you're not going to refinance for 2, 3, 4 years. But to give you an idea, a monthly payment on 100K at 4% interest rate is $477. Monthly payment on 100K at 5% is $536. It's 12.5% difference. So if you're expecting to get a 4% when you're refinancing thing and you actually get a 5%, you're going to get less cash out. You're going to get less money out. You're going to have a bigger payment. You're going to have less cash flow. So you do have to be a little careful. You kind of want to get a cap rate of 1.5 higher than when you expect to refinance the thing. So that's why I say you got to be a little careful about that. Same thing here, 477, 477. So same thing, to get to a 477 payment at a 5% interest rate, you would be at $89,000. So that's about 11% difference. So it also does affect real estate a little bit. Like, we've been lucky over the last 12, 13 years that we've been in a very stable interest rate environment, and properties have been going up in value. So it's been very forgiving. You can buy a property, screw up, and then sell it, and you sell it for more than you bought it, and maybe break even or even make a little bit money on a property you kind of messed up on. So it's been very forgiving over the last few years. And that's since we're going to rising interest rates now, now's a good time to be a little bit more cautious and make sure you get a little bit more spread than that 1.5, because interest rates are going up. Everybody knows that. So here's some educated guesses on what's going to happen with real estate going forward. So if you have rising interest rates versus inflation, just here's some math to give you a little bit of an educated guess. You have an inflation of 7%, right? That's what they're saying we have. So your 100K increases 107K, right? But then rising interest rates declines your value by maybe 12.5%, right? So then maybe your building's only worth 93,620 for every 100,000. These kind of things can happen when interest rates rise. It's not guaranteed, but then in a year you might get a 6% loss in value instead of a 10%, 20% increase that we saw over the last couple of years. But that's why you really want to be careful with your cash flow, because overall, in any 10-year period, real estate's always going to go up. But if you put yourself in a corner, so a year later, you really have to get cash out of that thing, or you're not cash flowing and you're depending on refinancing it, or you get yourself in hard money, you got to really be careful to make sure that you do your numbers right, so you're cash flowing on property, so you can hold that property for as long as you need to. So hopefully that'll make sense to everyone. But these are just sort of like educated guesses. I don't really know what's going to happen, but it's good to educate yourself a little bit and just understand that rising interest rates can make properties worth a little less. So be careful about that. Cap rate change due to higher interest rates. So the reality of this thing is, when you get into this kind of stuff, you got to make sure that there's a lot of people like me that are not going to buy a building at a 4.5 cap rate if I'm getting a 4.5 interest rate. And those are the people that are going to have the most purchasing power. So they're going to dictate the market going forward. So once again, it's just more, you got to be careful that your values can go down, and you want to be very careful to make sure you have cash flowing properties. And if you lock into an interest rate and it's cash flowing, you protect yourself from all of this. And so you go a year later, it goes down, but 5 years later, you're probably going to have a very good increase. So you got to make sure you're always set up to hold a property for as long as you need to, in order to, fare the storm if the storm comes. Um, why are they going to need to raise interest rates right now? Banks are lending at 3.5 to 4.5%, and inflation is at 7%. So if anybody looks in history, interest rates have never been lower than inflation. So that's new territory for people right now. And if you think about it for a minute, what happens if you're loaning money out at half of inflation? That's going to make banks not very liquid. So this also potentially could tighten up lending. The government doesn't really want lending tightened up and all that kind of stuff, but do understand that this does cost banks money to be lending money at a lower rate than inflation. So you got to be very careful about that. And so they pretty much have to raise rates. Hopefully they can just feather them up and bring this inflation down and only rates up a little bit. The good news is I don't think there's any world that the economy is going to survive 6, 7, 8% interest rates. So I think your safe bet is probably going to be in that 5% range. So, I don't really know any of this for sure, but I just think it is important for everybody to remember to do your numbers, make sure your building's cash flowing. So if you get a storm in this time, then you're okay. That's very important. Because I've been through a down market, and the people that survive are the ones that make sure they're cash flowing on their properties. So you got to be a little careful about that. A couple other things. Minimum wage also, federal minimum wage has also not gone up for the longest period ever in history as well. So a lot of cities are making some weird rules because of this, because everybody's heard of affordability issues. Anybody that's tried to buy a house lately would agree with that. So a lot of cities and states you got to watch for right now. They are making special rules. I know in Seattle, they put on 10 or 20 different rules about how you can raise rents. You got to do 6 months. If you raise over 10%, then if they're under a certain income, then you have to pay them to move if they want to move. And so there is a bunch of legislation in a bunch of cities. So it's pretty important to research your cities to make sure you know what you're getting into. Because if you buy a property that you want to raise rents by 10% and you have to wait 6 months, and then if they say I'm poor and you got to pay them $10,000, you got to be careful. Like in Seattle right now, if you buy a property, you got to give them 6 months notice to raise the rent. And you don't want to do it by more than 10%, because then they can potentially charge you. The tenant could say I'm too broke for that, and then you have to pay the tenant to move. You got to pay his moving costs. So check with your cities, because a lot of this legislation and stuff is coming out right now. So people do have to be careful about those kind of things right now. But the government seems to be pushing more towards subsidies instead of bringing incomes up. So watch out for that. Good or bad, it's a fact. So it is what it is. So just watch out on that stuff. What does $7.25 minimum wage mean to a landlord? This is particularly interesting if you're looking out of state, because if you make $7.25 an hour and you have $15,000 a year in income, and the average rent in the United States for one bedroom is $12.56, the guy making $7.25 an hour can't pay that. It just doesn't work. So you do want to check your incomes in areas you're investing to make sure you're not trying to push rents in a situation where people just can't pay there. If you get 15,000 and you do 43% of 15,000, then that's what you would need to qualify for mortgage, is 43% of your income. Someone making $7.25 an hour could probably only afford $540 a month in rent, is reality. So you want to check on in these real poor areas. A lot of states have higher, but if you're in a really poor area, just understand that you might top out at not very high rents. And so watch out for that a little bit. If you go to like a finance guy, they're going to say 30% should be what you pay for rent of your income. which would only be $377. I don't actually know anywhere in the country you can get rent for $377. The average rent for one bedroom in the United States is currently at $1,216 a month. So, or the median, which means half of the people in the United States pay more than that and half pay less than that. This $16.34 an hour is what you would have to make to be at 43% of your income to be able to pay median rent in the United States. The good news is if you extrapolate it out, $16.34, it comes out to about $34,000 a year. And rent, that's what median income in the United States is right now. But it does mean half of the people make less and half of the people make more. So just when you're looking out of state, just make sure incomes are in the area enough so they can pay rents. If you're trying to take a B class property and change it to an A class or a C class to a B class, make sure that the incomes in the area are able to do that. So when I'm looking out of state, these are a lot of things I've been starting to look at. That's why it's also good often to be in a suburb of kind of a city, because a lot of times cities will pay more wages. But if you're like in the middle of nowhere in Oklahoma, you're probably not going to be able to, or we can pick on Justin in the middle of nowhere, Kansas. You know, you might not be able to pay, you know, $1,500, $1,600, $1,700 a month on rent. You just might not be able to do it because you're just not making enough. So those are just some things I want to be careful about going forward, and things you really want to research your markets to make sure you can do what you want to do. I guess if I'm at a half an hour here now, so if anybody has any questions, we could go through some questions now.
Yeah, Joe, thank you so much. Yeah, we do have some questions in the chat, and okay, can you guys hear me all right? All right, perfect. But if anyone else has anything else, feel free to just keep them coming. But Joe, are you ready here?
Yeah.
Awesome. So we had one come in from Kira. She asked, when you buy with tenants, do you factor in the eviction cost, or are you only buying properties that don't need that much work?
It depends. I mean, sometimes you buy properties, you got to evict people. And, you know, that's another thing. You got to make sure you understand the eviction laws, which have been very strange over the last 2 years. Sometimes you can't evict them at all, and you got to just talk to them and see if you can get them to move. But yeah, so anytime you buy a property, and if you have eviction costs or something like that, you kind of, like if you're at a 6 cap rate property, you want to take those costs off or add them up and probably discount that property so you could stay at a 6 cap rate to still have a 6 cap rate after your eviction costs. So that's when you find the inspection. If you find somebody's not paying rent and all this kind of stuff, and you got to spend $5,000, $6,000, $7,000 to evict that person, you want to say, hey, you know, I'll buy this property, but you know, I want to pay $5,000 less because I got to evict this guy.
Great. Awesome. We have another one here from Charlie. He asked, outside of making your offer more competitive, and perhaps it's not even not being your money to begin with, why would you use that amount of cash and tie it up for 6 months?
Why would I use that amount of cash? Because, well, for me personally, the hardest thing for me has been getting enough money out the door over the last year or so, because it's just hard, and it's all a calculation. Because if you can get a 20% discount on a property because you're buying in cash because the guy wants to close quickly, then you're making 20% on your cash, and that's about, you know, 20% isn't too bad. It's just a dollar thing. You just do the calculation. If you're going to get a really good deal, because as you saw in the first property, if you buy a 6.5 cap rate property, you might have to wait 5 years to get all your money back out.
Mm-hmm.
Or certainly 3 years, even if you raise rents 10%. Now, if you can buy a property in cash and get it out in 6 months, more than what you put into it. So you put 185 in and you get 280 back out, you know, that's great. You absolutely buy that property in cash.
Yeah.
But typically I would not buy a property in cash. That's not going to be a deal where I'm going to get more money out after renovation and expenses than I bought it for.
Gotcha. Awesome. Hopefully that answers your question there, Charlie. I think he had to step out for a bit, but we have another question here from Lisa. She asked, what's your recommendation for commercial financing for a new investor? I believe she's looking at a 6-unit under 700K. Would you recommend local commercial banks, or is there a better option?
Yeah, so if you're under $600,000, it's a little bit harder to find loans because a lot of banks don't, once you get under 750,000, you have to deal with smaller banks often. But a local bank, I mean, it depends where it is and what you're trying to accomplish, but a local bank can be very good. If you really feel very, very inexperienced, you can go to a mortgage broker, commercial mortgage broker. I think a few people have used Joe Wetzel around here. So that might not be a terrible way to go, but you can always try and call a few local lenders. I do have a topic on the forum that I went pretty in depth into commercial financing because it's different. They go by debt to service ratios. They want your net operating income to be 1.25 usually. And they do it that way instead of a debt to service ratio where they want it to be 43% of your income. So they focus more on the billing's income than the thing. And a few questions you really want to ask those lenders is what's their debt to service ratio? How do they calculate it? Because different banks will calculate it differently. And, but yeah, a local bank, like I've used Pacific Crest here in Washington a few times and they're super easy to use. BCU is a little bit harder, but they give you a better loan. You can do things like US Bank, but you're going to get a very low LTV, but they're going to be the least amount of costs. If you go to a Chase Bank, they're a pretty good deal, but they're typically only going to do larger deals. So with commercial banks, you really got to ask them a lot of questions to make sure they're lending at the time, because every bank has different loan types they want. They want so many residential, they want so many commercial, they want so many office space. So sometimes it's a little hard because you got to figure out if they want that type of loan right now. And usually they won't tell you up front. So you kind of got to figure it out through grapevine. But, so it's a good thing if you're in a specific area to maybe ask people that are buying buildings in that area if they know anybody lending on commercial property right then, or maybe ask the realtor you use if they know a commercial lender there right then. But usually the smaller the bank, the easier the process is going to be, because you get to actually, sometimes the guy you're talking to will actually be on the loan committee, because most banks do it by loan committee. So they bring so many loans in and then the committee looks at them. If they want to fund 10 deals and they only get 5, then they might fund all 5 of them. But if they only want to do 10 and they get 20 deals, then they're only going to fund the 10 ones they like the best. So anyways, probably more, that was a mouthful.
No, I think you did great. We have another question here from Kira. She asked, what markets do you like right now? I'm sure that's that golden question everyone's wondering.
Yeah, obviously I bought a handful of buildings in Clarksville. I like that okay, because I like it because Tennessee, I do like Tennessee pretty well because it's no tax state. I do tend to look at no tax states. They're great because you're not paying taxes. And then 2, it's outside of Nashville, and Nashville's a name city. You go someplace in Japan, they're probably going to know Nashville even. So I think submarkets in name cities are pretty good. It does depend a little bit what you're looking for. If you're looking for higher cap rates, oftentimes higher cap rates, sometimes you're going to be a little bit riskier markets. I mean, you can go to Detroit and get as high cap rate as you want, but I don't know if you'd want to buy there. But Tennessee, I like Chattanooga, I like Clarksville. I've looked at Memphis a little bit, but I waver a little bit. Obviously, Austin would be awesome, but the properties are way too expensive. I've looked in San Antonio a bit. It seems my hardest part there is it's a big city and it's hard to tell the area well. But right now I look a lot in Chattanooga and Clarksville. I like both of those really well. Spokane's really good. There's a lot of, Texas is growing really fast and there's no tax. So there's quite a few places in Texas. I even looked at Omaha at one point, but I couldn't quite get the numbers to be what I wanted in that city. But the less I like the market, the higher cap rate I want is basically. The big thing is population growth. But if I don't like the city, the higher the cap rate I want.
Gotcha. And then are you just specifically in Washington and Tennessee, or are you in a couple other markets as well?
As of right now, I'm just in Washington and Tennessee, and then I've got it in Spokane too, which is might as well be out of state. It's almost in Idaho.
Gotcha. Great. So we have another question here from Mark, which is actually something I was going to ask. So great job, Mark. But did you use Section 8 in low income areas for rental income?
I have used Section 8. There's nothing wrong with it. Basically what it is I have some Section 8 tenants. There's nothing to be afraid of with Section 8. As long as the property is in an okay area, then Section 8 is okay. Because Section 8 will pay part of the rent consistently. And they don't want to get off of Section 8 because if they lose their Section 8, they don't have the government paying part of the rent anymore. So I actually have a Section 8 tenant in a nice part of Seattle. I have somebody that's that's on a government program in Everett, Washington. I'm sure up in Mount Vernon, we've got some people doing that, but Garnett watches over that building for me. So.
Awesome. And do you have like one you favor more, like a Section 8 or a non-Section 8 tenant?
Most places that would be illegal to favor one or the other.
So. Well, yeah. Okay. maybe I phrased that wrong. We'll just
I don't have any problem with anybody that has good credit.
There we go. Love to hear it. All right. So we have one from Cecilia here. She asked, can you talk about how you found the deals you got last year and what your due diligence process is for out of area properties?
So yeah, I just look a lot. I have a handful of areas that I just check the MLS every single day. Because the good deals are not going to sit there for a day, a month, a year. They're going to come and go pretty quickly. Some of the ways to get good deals is to be very clear and decisive. Because nobody wants to come in and be like, oh, I don't know if I do or don't, or this or that. They're going to bail and go for the guy that's, yeah, I want it. This is how much I'll pay for it. Due diligence. I'm not too careful about that kind of stuff, but I've partnered with Garnett on some of these things. So we flew him out. We've been flying him out different places to look at these buildings because he knows what he's doing. So I just fly him there. He looks it over, hand him the cash, and there you go. If it's good enough, the kind of stuff I buy, like, power off crap buildings, you almost don't need due diligence because you need to do everything anyways.
True. And it's probably just because you have so many properties in the area and you're only in 2 markets that it's pretty simple to do your due diligence because you already have experience in those markets, right?
Yeah. I mean, it's the first you got to figure out is the area. And then second, you got to get somebody out there that you trust to look at the building. So whether they're there or your realtor knows somebody, you have an inspector, somebody should look at the building. I mean, the faster you can get that done, the easier it's going to be for you. Because especially in a market like this, people don't want to see 30-day inspection periods. They want to see 5-day inspection periods.
Mm-hmm. Awesome. We got another one here from Char. She asked, what property type do you find to be the best? And she listed out basically like A- to B+, B to B-, or C to D properties, and etc.
Well, the best properties are really crappy properties in nice areas, and then you get them for cheap and you fix them up, and then you get real high rents for them. So if you can get a C-class property in a B or A-class area, that's where you're definitely going to do the best, because then any money you put into that, it's going to do you well. Like, you can get higher rents. You put $500 in, it's probably going to be worth $1,000 more. What you don't want to do is buy an A-class property in a C- area, because you're going to get just a bunch of people ruining your super nice property.
Awesome. And Joe, you mentioned that you self-manage, mostly, if not all, your portfolio. Is that correct?
Yeah, I mean, so I partnered with Garnett on a few things, and so I'm just the money guy in those, and he deals with them now,
Okay.
and that's what I'm trying to move into now. But yeah, I manage most of my properties. Um, it's not that hard. I mean, it's like anything else. You practice, you get good at it. Um, the big thing is to not let people make you angry. It can be emotionally trying sometimes, especially like during the pandemic when you got somebody that hasn't paid for 5 months and then tells you, "Oh, my fridge is broken," and you're like, "But you haven't paid in 5 months, and I know you're getting unemployment." So you're like, you gotta stay unemotional about it and just look at the numbers of it and overall, and also you gotta, you got to make sure your paperwork's in order and you don't break any rules, and you got to be careful about that. But the big thing is nowadays, the more you can do online rent payments and stuff, like for instance, the Spokane property, we're self-managing it right now because there's online payments. So we had 3 tenants. So we're like, well, we'll save on management right now. And we'll just have them pay online. So now we're not paying management. And if all the management company does is call, if something's broken, they call somebody else to come fix it. It's not like the management company actually comes out themselves. They have
Mhm.
a maintenance guy come and fix it. So the only hard part about managing out of state would be keys to tenants, really, in this day and age. Because there's also showing service. Like in Seattle, I use a company called Show Digs. So even in Seattle, I don't show any of my properties anymore. And then I'll email them the lease and have them sign online. And then I'll just put a lockbox on there. And sometimes I even just tell them, go let yourself in because I've already got their payment online. So nowadays, it's pretty common for me to rent somebody in Seattle without even ever meeting them.
Cool. And do you know the name of the software that you use to track all that?
Well, I don't. I collect a lot of rents by Venmo, but I don't recommend that because I like it because it's instant.
Mm-hmm.
But they have recently changed the rules, and they're going to start 1099 people if they click on the business transaction. And also now you can click on the business transaction, and then it will charge me a fee of 1.9%. So Venmo has recently gotten terrible about that. I also use a company called Azibbo for collecting rent. They're both supposed to be a bank and a rent collection thing. So I'm using Azibbo on some properties right now, and then I'm probably actually going to switch over to Buildium going forward, to switch all my Venmo pairs to Buildium, because that's probably Appfolio and Buildium are probably the most renter friendly for collecting rents. I would definitely recommend Buildium over Appfolio because Buildium's a lot cheaper to begin with, and it's more, if you're an owner operator, it's more, you can change a lot more stuff. Appfolio is made more for having a management company, so it's really hard for people to change stuff because they don't want their employees screwing up all these things. So it's Buildium's probably better for the small landlord than Appfolio. And I would probably stay away from the Venmo these days because they're going to 1099 you, and every tenant's going to click on that thing and it's going to charge you 2% on your rents, and it's not so good now.
Yeah. Well, awesome. Thank you for sharing a little bit about the self-managing. We do have a couple more questions here from Cecilia. She asked, how often are you refinancing your commercial properties after they are stabilized, and what length of time would you recommend locking a commercial loan for?
So it depends. It depends. Like if I can get cash out right away, I'd do that thing fast as possible. But with a commercial property, usually you got to have 1 year of tax returns of good numbers before they're going to give you cash out. So if in 1 year you can get good cash out, then fantastic. On average, I'm probably refinancing everything about every 5 years. I've got enough properties, so there's no real reason to do it more quickly than that. I will admit right now I'm working on refinancing 4 properties because I'm pretty sure interest rates are going up. And I'm locking 1 at 7 years and then 2 at 5 years. And then we're doing another one at 5 years. And then we're hoping to also do that triplex and get money out of that. And that'll be a 30-year lock. But on average, I refinance about every 5 years. Because
Gotcha.
as you see in your extrapolation in the beginning, you just raise your rents by 3%, you can usually get all your money out in 5 years, no matter what you do, as long as you didn't
Yeah.
make a big mistake.
Yeah. Love it. We have one last question I see here from Kira. She asks, how do you manage contractors from afar?
Well, you hire a guy named Garnett, and then you say, I'll partner on properties with you, and then you have him do all that for you. It's just that is the hard part about a state, because you can't see it personally. So you got to have a little more trust in your contractor. One contractor we found through the realtor we bought the property from, and that guy had a contractor, and we're using him, and he's working out great. Another contractor we used, we had him do a few things for him, and they screwed a few things up, and it wasn't so great. But yeah, you just got to call around, make a lot of calls. If you can get references, certainly, you know, that's part of this whole group, is like, if you can talk to people that are doing properties in the area to try and get their contractors to help you out. I hear the Chattanooga people are pretty good. We talked to a guy down there looking at a building at one point, and he seemed pretty good. But yeah, that is the most difficult thing that we have going on right now, because with all the labor shortages, there's not enough contractors for the people that want contractors right now. So it's a little tough. I know around here in Seattle, we got enough work going on, so you get a little bit more allegiance from them. And that's easier if you have enough work to keep them busy, then you can get better deals and whatnot. So certainly if you're talking to people here and a bunch of people have used it, make sure you mention that. Another thing about contractors, always, you really want before and after pictures. And also another big thing you really want to do is, when you're getting into this business, you know, one of the books, you know, people read The Rich Dad, Poor Dad, and all this kind of stuff, but you should be reading Home Depot 1, 2, 3 too, because when a guy calls you up and says, yeah, I need to change your joists and 4 of your piers, and I gotta do this and that, if you don't understand what he's talking about, you don't know if he's talking about $20,000 worth of work that he's charging you $500 for, or if he's charging you $20,000 for what you should only be paying $500 for. So I would recommend to everybody to go and do a lot of research on structures of building and what's that and how all that works. Read your Home Depot's 1, 2, 3. So when you're talking to a contractor, you know what he's talking about. Because if you don't know what he's talking about, he's going to take advantage of you 9 out of 10 times.
Great. Awesome. Well, thank you so much, Joe, for all the information you provided to everyone. But before we wrap up here, our community manager, Diana Lowe, is actually going to come on. I know we have some new faces in here, some people not a part of our awesome ROI Inner Circle community. She's going to run through a couple of example deals, including an apartment complex deal, just some things that we regularly see inside of our community. So, Joe, if you could, perfect. And Diana, you want to start going there?
Thank you everyone again for joining us tonight. We appreciate you spending your Wednesday evening with us. As Justin mentioned, we do have some deals to show you right here. So this is one of the deals we have available to our investor database right now. It's in Des Moines. It is already renovated, so quite the opposite of what Joe's wheelhouse is, but good for the investor that wants to just get their first property or work on scaling up and not need to put in a lot of work. So the suggested offer price here is $185,000, potential rents of $1,900. And with these numbers, you can expect a monthly cash flow of just over $500 and a cash-on-cash return of almost 13%.
Wow.
Another deal that we have available for investors is in Phoenix, Arizona. This is a beautiful turnkey 4-bed, 2-bath with a casita and would work really good as a short-term rental. And you could even live in the house and rent out the casita. So the asking price here is $715,000 with the potential monthly rents or income of almost $7,000. So your cash flow would be about $2,400 and cash-on-cash return of 16%. I mean, look at that house. It looks gorgeous. I would love to live there and get away from any of the cold in the winter. Would make a great second home. And then we also have this larger deal available in Missouri. So this is a 15-unit apartment complex built in 1954. The suggested offer price is $1,300,000 with the cash flow of $4,000, cap rate of almost 9%, and cash on cash return of 14.5. So again, these are just some of the deals that we have available for our Inner Circle members. If you'd like to gain access to more of these deals, and we also have a investor trip coming up in May to Tennessee, which is one of Joe's markets, then we would love to have you in the Inner Circle, which is addictedtoroi.com/inner circle. Again, we do have a investor trip coming up in May where we'll be visiting Chattanooga. We'll be meeting with some of our agents that we recommend there and touring properties. So it's a perfect time to get a glimpse of the market and see what's available for you there. Thank you again so much, everyone, for joining us tonight. We hope you have a great rest of your night. And if you have any other questions for Joe, we will be on here just for a few more moments. And thanks again.
Thanks, everyone. Have a great night.
Thanks, Joe.
Yeah, thank you. Do we do any more questions or are we all good to go?
We'll see if anyone sticks around.
Looks like everyone might be ready for dinner. Well, thanks again.
Hi.
Oh.
Hey,
I
Kate.
had a question. Will you remind me, please, what on your slide, what was that projected kind of decrease from inflation in the next year or two?
So I just said the thing is, so you could potentially get a like 11% decrease because of interest. If interest rates go by 1%, people are probably going to want to pay 10%, 11% less for properties, just because your numbers don't work at that.
Yeah.
But if you have inflation of 7%, then maybe it factors out to maybe a 3 to 6% loss. People have been crazy, so you never know, but it's entirely possible that that could happen.
Okay.
And, that's why you always want to be careful is make sure you got cash flowing properties. I would be very surprised. I mean, obviously we know things can't keep going up at the rate they've been going. Nobody can afford anything then. So at some point it's either going to go down or stall out. And I would guess it's coming very soon, especially with interest rates going up and inflation and all that kind of stuff. And people got to remember, as the stock market's going down and the interest rates going up, there's a lot less liquidity out there. Like I can pull out a lot less money out of a property at a 6% interest rate than I can at a 3% interest rate.
Okay. Yes, that all makes perfect sense. Thank you.
So I got a question. Do you invest in any closed REITs or anything like that? Do you diversify into those? Or is everything you have locked up into your own properties that you manage yourself?
Everything's locked. I own everything. I don't invest in the stock market or banks or I haven't done any syndications. I own them.
There you go. Okay, no, I was just curious if you did any like a Delaware investment trust or stuff like that. If you diversified into those.
I looked into those things a little bit, and it's like, but
you're locked up too long. It's like a 10-year, 7-year minimum that your money's locked in there. That's the problem. But I've referred people there for a 1031 exchange when their properties fall through, and it's like, what the hell do I do? But,
right. And I'm thinking if you're looking at like, okay, you're doing a 1031 exchange and you're thinking of, and you're sort of investing in properties as an alternate to a 401k or something like that.
Yeah.
It's probably not a terrible deal. But if you're really looking to make money in properties, if you own it, then you can be the one to make decisions, make the most profit. Because what ends up happening is even in syndications and whatnot, you're at the mercy of, do they know what they're doing or not?
Yeah, pretty much.
Yeah.
Pretty much.
Because sometimes people get greedy.
That's human nature at some point.
Yeah.
Do you take advantage of Airbnbs or everything long-term rental with yours?
So I don't really like the Airbnb thing because I don't want to be a hotel thing.
Yeah.
I have one apartment that I have somebody Airbnb in and out for me, and I do a 60-40 split with them.
Yeah.
But it's sort of just one that I'm having wait for renovation. So for me, I'm like, okay, well, I'm Airbnb until I can get to it to renovate it because I'm trying to renovate a lot of units right now. And so I'm doing that. And I think that's good use of an Airbnb. But to do an Airbnb, it's more work.
Oh,
Is the way I see it.
100%. I have
So
a,
I don't want more work. I'm getting old. I want less work.
oh, dude, it's crazy though, because I manage 4 of them down here in Arizona, and the rents that they get on them are insane. $850 a night, $760 a night. Some of them, it's insane what they do over here. So those cap rates are wild,
Right.
but the management aspect of them is a pain because constantly have in, out, in, out, in, out. People are complaining, different person every time. So
I
it
can tell
is.
you, you're not going to Hawaii for a month and a half if
Oh,
if you're managing 4 Airbnbs.
wait until you get to 10, 12, 15. Property management companies will look at you and go, yeah, you're out of your mind.
But I don't think anything's off the table when you're starting out. If you got time but not money, and you can make a lot more money doing the Airbnb, then absolutely, make whatever money you can.
Yeah, no, 100%. Grab it while you're young.
The other problem is financing. Airbnbs are hard to finance because they calculate it very differently with the Airbnb money than they do straight rental.
Depends. We can gross up Airbnb property income. We've got loan programs for that.
Yeah,
But,
so you can get loans on them.
Yeah,
But they do them differently than rentals. They do them differently.
little bit.
Yeah.
Depends. All right, that's all I got. I was just curious what your take on those was.
I think they're great if you got the time. I don't, if you want to have 100, 200, 300 units, there's no way you're managing 300 Airbnbs.
No, you might as well be the Marriott at that point.
Yeah. Yeah.
True.
I have a quick question. I'm in the process of refinancing a 6-unit in Spokane and with GISA Credit Union, and they're saying that we can't lock the interest rate until closing. Is that pretty normal for commercial, or does it just vary by lender?
That's not that normal. Usually they will lock it. Some commercial lenders do say, okay, whatever. Can I ask what interest rate you're getting?
It's.
Oh, I guess they haven't locked it yet.
Yeah, I mean, they have an estimate and they said they don't think it will change, but they said they can't officially lock it until closing. It's 4.35, I believe, for 5 years.
4.35. Okay. So you could talk BCUs would do Spokane. And if you can qualify with them, they're going to be your best option in Washington State. But BCU is probably going to be a bit lower interest rate than that.
Mm-hmm.
Because I can't remember what I called them the other day because I was looking to refinance it because I'm doing Freddie's because you can do Freddie's over $1 million and they're like low 3s right now.
Mm-hmm.
But I want to say BCU was like 3.6 or something like that. They're pretty good. And they will definitely do anywhere in Washington.
Okay. What's like the requirements? Like when you say qualify, like what's the hard thing to qualify for with them?
So with them, their difficult part with BCU is they do a global cash flow as well, which means they're going to look at your cash flow. And the problem with that is they do your cash flow as though all your credit cards are charged out. I mean, you might have $0 in your credit card, but they do it as all your credit cards are charged out. All your lines of credit are charged out. And so with a guy like me, I have, I don't know, 5 or 6 $20,000 credit cards. I have $500,000 in lines of credit. And, they might all be at 0, but if you charge them all out and then you want a 1.25, service ratio, global cash flow, then it's a little hard. So if you've got very good cash flow and if you're still like in a W-2 job and all that kind of stuff, it might be a little easier, but that's their thing is global cash flow is because they charge all your credit cards and the payment they do 2% per month of fully charged out. So if you have $100,000 in credit cards, they're going to be charging you a $2,000 a month payment on that.
Okay, gotcha. And on the commercial refinances, I mean, we're just doing our first refinance. This is our first time doing commercial refinance, and we've had the appraisal inspection done, but we haven't gotten the appraisal back. Is it pretty straightforward? Like they should just be looking at the cap rate, or do they get into you paid this much for it and you put this much into it, and then there's kind of like a limit to what they'll, say the value is? Like, have you ever run into issues with that?
I don't know. Are you just buying it, or you owned it for a little while, or?
Yeah, we've had it for like a little over 2 years. So it's been fully stabilized for a full year.
Okay, then they're not going to worry it. So what they're going to do is they're going to do it 2 ways. They're going to do comparables, and then they're going to do by cash flow. like what, so they're going to do a little thing and they say what market rents for that, and they're going to say whether they think you're below or above, and then they're going to go by what you have your rents, and then they're going to kind of come up with their cap rate type thing. But then they're also going to do a comparable, and then they're going to sort of average it out a little bit. What the bank's really going to look at is to make sure what your numbers you gave them are not higher than what their appraisal says is market rents. Does that make sense? Now,
Yeah.
if your rents are a little lower than what they're saying is market rents, then that's great. Maybe you can even argue with the bank and say, well, my rents are even a little low, so maybe you can be a little leaner on the debt to service ratio. Because I don't know, they probably, do you know what they're at? Are they at 1.25 or 1.2 or 1.15?
For the debt service coverage ratio,
Yeah,
1.25.
yeah, that's pretty number.
That's what the bank is looking for. I can't remember what it would be at, like what the property actually would be at.
Yeah, so that's what they're looking for. They want you to be above 1.25. And I don't know, some banks do global cash flows for you and look at you personally as well, and some don't. Like if you go to Freddie, they don't care about you at all. If you go to a US bank, they're very stringent on a lot of things. Like I say, BSU is a little stringent on personally, but 1.25 is normal what they're going to ask for. And as long as you're above that, it shouldn't be a big deal.
Okay. Okay, awesome. Thank you.
Looks like Patty, you have a question?
Hi, hi Joe. I am curious about as a investor who hasn't invested in a commercial type of asset class, how would you like fast track, or is there any way to fast track in being able to invest in that? Because obviously banks want to lend to people who are experienced and have like commercial background, I presume, and doing, for example, a refinance on it if I plan to BRRRR it. And I'm wondering your thoughts on that aspect of it. Other than I think another track is being able to partner with somebody who is commercial, who has commercial experience.
Yeah, so it depends. I mean, they'll take 1 to 4 rentals as experience. Now, if you have one duplex and you say, oh, I want to buy this 50-unit building, they might ask you a few questions. But if you own a couple duplexes and then you're going to do a 6-plex or something, then they're going to be fine with that. That's experience.
And typically it's been like a 1 to 2 year, I guess, turnaround time, for getting a property, renovated and stabilized, and then being able to use that for refinances, I think is what I've understood in terms of the whole like life cycle of it.
Yeah, in a commercial property, so 5+ units, they want 1 year of stabilized tax returns.
Has there ever been a case where it's been less than that?
So if it's less than that, like if you buy a property, it depends on the lending environment. If it's very aggressive, you'll find the occasional bank, and usually they're going to be a local bank, that will go off the appraisal numbers, what it says you should get for market rents, and they'll just go off the appraisal, and they'll do the numbers off the appraisal and do all of that. As long as your rents are there and you don't have history on it, typically if it's within a year, they're not going to want to do more than 75-80% of what you purchased it for. So it's very hard to do it in less than a year on a commercial property. There's very few banks that are going to do that for you. Occasionally you get one that'll go by they'll do pro forma numbers. But those are probably far and few between. I think I use Pacific Crest up here in Washington, and I think they'll do it. But they're not going to be totally outlandish. You're not going to take a vacant building to somebody and say, here's my pro forma numbers, and they'll loan you $1 million on it. But if you have it fully rented out at where you're saying your numbers are, then you have a better chance.
Mm-hmm, mm-hmm. Cool. I have a bit of a off subject question, but like if you were to do anything different in terms of like your investing strategy all the way in the beginning, like would there be any other different way you would have done it in terms of building cash flow and wealth through commercial real estate investing?
I just wish I knew my numbers a lot better back then, because my first property, you know, I was 20s and I was just like, oh, I'll buy this place. And you know, I didn't do numbers or anything. It just seemed all right. But I can tell you, starting out, you can get your best loans on owner occupied. So if it's like your first property, ideally your first property would be a fourplex that you owner occupied. And then maybe you can buy it with an FHA and only put 3% down. So you're going to get your very best bang for your buck. And then you can live there, do a lot of the work yourself. So unless you're making $500 an hour, you cannot pay these $500 an hour guys, do it yourself. And you're going to pretty quickly be able to get all your money back out of that property. So, I mean, if I went back, I wish I knew my numbers more, and I did a lot more of that. But as I got better at it, I've done fine. So I don't have any regrets. You got to learn. You're going to make mistakes learning. You know? It's easier to make mistakes learning when values are going up and interest rates are low than when interest rates are going up and values are going down. So.
Yeah, I think like the specific context that I asked that is because, you know, being able to invest in commercial, you know, obviously takes maybe more time, or, you know, in your case, you did a lot of the sweat equity yourself. And so I'm wondering if you would have done it any other way where it's like less of a headache. So you could kind of like reverse your track right now where you're trying to do less of a headache type of deals now, if you would have done it earlier, if you knew some other way.
Yeah, there's no question that to begin with, doing your own stuff is great because you can save a lot of money that way. I mean, I was working detailing cars when I started, so I was making like $7 an hour. And, you know, so there's no point in me paying somebody $50 an hour when I'm making $7 an hour. So, but as I've grown bigger, I haven't transferred to hiring people out to these things as fast as I should have. So once you get to enough money to sort of just be the numbers of it, it makes a lot more sense because time is of the essence a lot of times. Because if you can buy a building and renovate it all in 3 months, and then at 6 months, cash it back out on a 1 to 4, then that's better than spending 3 years fixing it up yourself. Even if you spend a little bit more on it.
Yeah. Great, thanks.
Great questions. Hopefully everything works out and you can find your first commercial property. Awesome. Does anyone else have any other questions for Joe before we kind of wrap things up here? Anything? Last chance? No? All right. Well, thank you, Joe, so much for sticking around for some extra questions here. You're definitely a wealth of knowledge in the commercial space. So if anyone has anything, I'm sure you could tag him on the forums direct or message him directly, and I'm sure he'd be more than happy to help you guys out. But
yeah, I do check the forum, and if you really are questioning about commercial real estate, I did a pretty lengthy discussion on it at one point. So it's got a lot of good information in there.
Awesome. Well, thank you so much, Joe, and everyone else. Thank you so much for being here, and hope you guys have a great rest of your night.
All right. Good luck, everyone.
Thanks, everyone.
Thank you, Joe. Take care.
Bye.